Welcome to Part 4 of our FCRA 2010 revision series. In this session, we move beyond registration requirements and focus on the complete life cycle of an FCRA certificate. We will understand how foreign contributions are released in installments, the mandatory identification requirements introduced for transparency, and the important provisions relating to suspension, cancellation, surrender, and renewal of registration. These areas are highly relevant from an examination perspective because they contain multiple timelines, conditions, and practical scenarios frequently tested in CA final exams. By the end of this session, you will have a complete picture of how an FCRA registration is managed, from its beginning to its eventual renewal, suspension, or closure. Before we begin, let's understand the roadmap of this chapter. We will first examine the conditions for release of foreign contribution received under prior permission. Then we will study the mandatory identification documents required under Section 12A. After that, we will cover suspension of certificates under Section 13, cancellation under Section 14, surrender under Section 14A, management of funds after cancellation or surrender under Section 15, and finally, the renewal process under Section 16. Think of this as the complete journey of an FCRA certificate, from receiving funds to maintaining compliance and eventually renewing or closing the registration. When foreign contribution is received under prior permission, the government does not release all funds without monitoring their utilization. Suppose an NGO receives the first installment of foreign contribution. Before the second or any subsequent installment is released, it must demonstrate that at least 75% of the previous installment has already been utilized. Merely submitting documents is not enough. The authorities may also conduct a field inquiry to verify whether the funds were actually used for the intended purpose. This mechanism ensures accountability and prevents misuse of foreign contributions by linking future releases to proper utilization of earlier funds. To improve transparency and strengthen compliance, Section 12A prescribes mandatory identification requirements. These requirements apply when a person seeks prior permission, registration, or renewal under the FCRA. For Indian citizens serving as office bearers, directors, or key functionaries, furnishing the Aadhaar number is compulsory. In the case of foreign nationals associated with the organization, a copy of the passport or Overseas Citizen of India card must be provided. The objective is simple. Every key person connected with the organization must be properly identified, enabling the government to maintain greater transparency and accountability in the administration of foreign contributions. Now let us understand suspension under Section 13. The central government may suspend an FCRA certificate when it is considering cancellation under Section 14 and believes that temporary suspension is necessary while the matter is being examined. The suspension is initially permitted for 180 days through a written order. If circumstances justify continuation, it may be extended for a further period not exceeding another 180 days. In simple terms, suspension acts as an interim regulatory measure, allowing the government to pause the organization's FCRA operations while deciding whether cancellation should ultimately take place. Suspension has serious consequences. During the suspension period, the organization cannot receive any foreign contribution. It is also prohibited from utilizing foreign contribution already in its possession without obtaining prior approval from the central government. However, there is a limited exception. If the organization applies to the government, permission may be granted to receive foreign contributions subject to specified terms and conditions. For examination purposes, remember these two restrictions clearly: no receipt and no utilization without approval. They are among the most frequently tested implications of suspension under the FCRA framework. Rule 14 of the FCRA rules introduces a very important restriction during suspension. The organization may utilize only up to 25% of the unspent foreign contribution, and even this requires prior approval from the central government. The amount can be spent only for the declared aims and objectives for which the contribution was originally received. The remaining 75% must remain completely unutilized until the suspension order is revoked. A simple memory trick is to remember the ratio 25 and 75. 25% may be used with approval, while 75% remains frozen. Cancellation under Section 14 is far more serious than suspension. The central government may cancel a certificate if false information was provided in the application for registration or renewal. Cancellation may also occur if the organization violates certificate conditions, breaches provisions of the Act, rules or orders, remains inactive for 2 consecutive years, becomes defunct, or if cancellation is considered necessary in the public interest. These grounds reflect the principle that organizations receiving foreign contributions must maintain continuous compliance and actively pursue their declared objectives for the benefit of society. Before canceling a certificate, the central government cannot act arbitrarily. It must first provide the organization with a reasonable opportunity of being heard. This reflects the principle of natural justice, ensuring that the organization gets a chance to explain its position before any adverse decision is taken. Once the cancellation order is passed, a significant consequence follows. The organization becomes ineligible to apply for fresh registration or prior permission under the FCRA for a period of 3 years from the date of cancellation. This 3-year cooling-off period is a favorite examination point and should always be remembered along with cancellation provisions. Not every certificate ends through cancellation. An organization may voluntarily decide that it no longer wishes to receive foreign contributions and can therefore surrender its certificate under Section 14A. The process begins with an electronic application in Form FC7. Before accepting the surrender, the central government conducts an inquiry to ensure that the organization has not violated any provisions of the Act. Once satisfied, and after ensuring proper management of funds and assets, the government accepts the surrender request. The certificate is then deemed to have expired on the exact date on which the surrender is accepted by the central government. A common question arises. What happens to the foreign contribution and assets once a certificate is canceled or surrendered? Section 15 provides the answer. Any unutilized foreign contribution and assets created out of such contribution automatically vest in the concerned banking authority or prescribed authority. These assets remain under the authority's control until the central government issues further directions. The objective is to ensure that foreign contribution and related assets remain protected and properly managed even after the organization loses or surrenders its registration status. The role of the prescribed authority does not end with taking custody of assets. Acting under the directions of the central government, it may manage the activities of the entity, utilize the foreign contribution for authorized purposes, or even dispose of assets when necessary to fund ongoing activities. However, these powers are exercised only in accordance with government directions and public interest considerations. An important relief is also available. If the organization is subsequently registered again under the Act, all vested foreign contribution and related assets must be returned to it. Thus, vesting is protective rather than punitive in nature. An FCRA registration is not permanent and must be renewed periodically. Every registered person is required to apply for renewal within 6 months before the expiry of the existing certificate. This timeline is prescribed under Section 16 Red with Rule 12. Think of it as a renewal window that opens 6 months before expiry and closes on the date the certificate expires. Timely filing is extremely important because failure to renew within the prescribed period can result in cessation of the certificate and restrictions on receiving or utilizing foreign contributions. The renewal process involves several compliance requirements. The application must be submitted electronically in Form FC3C. It should be accompanied by an affidavit in pro forma AA from every office bearer or key functionary. The organization must also disclose details of its designated FCRA account. In addition, a renewal fee of 5,000 rupees must be paid through the payment gateway specified by the central government. For examination purposes, remember the combination Form FC3C, Pro Forma AA Affidavit, FCRA account details, and a fee of 5,000 rupees. After receiving the renewal application, the central government may conduct an inquiry to verify that the conditions specified under Section 12(4) continue to be satisfied. Ordinarily, the renewal decision should be made within 90 days of receiving the application. Once renewed, the certificate remains valid for another 5 years. If the government takes more than 90 days, it must communicate the reasons for the delay to the applicant. The government may also refuse renewal if it finds violations of the Act, rules, or prescribed conditions. These timelines are particularly important from an examination perspective. Failure to renew a certificate can have serious consequences. If no renewal application along with the prescribed fee is received before the expiry date, the certificate is deemed to have ceased immediately upon completion of its 5-year validity period. Once this happens, the organization can neither receive nor utilize any foreign contribution until renewal is granted. Further, all unutilized funds lying in the FCRA account and utilization accounts, along with related assets, automatically vest in the prescribed authority. This ensures that foreign contribution remains safeguarded during the period in which the certificate is no longer valid. Even after a certificate lapses, certain options remain available. The organization may apply for a completely fresh registration under Rule 9. Alternatively, it may seek condonation of delay by providing sufficient written reasons explaining why renewal was not filed on time. In such cases, the regular fee plus an additional late fee of 5,000 rupees must be paid. However, delayed renewal applications are not accepted beyond 1 year from the original expiry date. The illustration on this slide highlights an important lesson. Filing a renewal application without the prescribed fee is treated as non-compliance, causing the certificate to lapse despite the application being submitted within time. Let us understand the renewal provisions through a practical examination scenario. Suppose an FCRA certificate was granted on the 1st of January 2014. Its validity would therefore continue until the 31st of December 2018. Now assume the organization submitted its renewal application on the 30th of June 2018, well within the permitted renewal window. However, the application was not accompanied by the prescribed renewal fee. In such a case, the application is considered defective, and the certificate lapses on the 31st of December 2018. As a result, from the 1st of January 2019 onwards, the organization cannot receive or utilize any foreign contribution until the certificate is properly renewed. This illustration highlights the importance of complete compliance, not merely timely filing. Before moving to the conclusion, let us quickly revise the most important points. Under Section 11, subsequent installments of foreign contribution require proof of 75% utilization of the previous installment. Section 12A mandates Aadhaar for Indian office bearers and passport or OCI documentation for foreigners. Suspension under Section 13 of may extend up to 180 days, plus a further 180 days, while Rule 14 permits utilization of only 25% with prior approval. Cancellation results in a 3-year cooling-off period. Renewal requires Form FC3C, a fee of 5,000 rupees and timely filing within 6 months before expiry. These are among the most examinable provisions under FCRA 2010. With this, we complete Part 4 of our FCRA 2010 revision series. The provisions discussed in this session are heavily dependent on timelines, procedural requirements, and practical consequences. Therefore, focus especially on remembering the key numbers: 180 days, 90 days, 6 months, 3 years, and 5 years. Also pay close attention to the practical case study involving renewal without payment of fees, as similar scenarios are frequently tested in professional examinations. Consistent revision of these procedural provisions will help you confidently tackle both theoretical and case-based questions in CA final examinations. Welcome to Part 5 of our FCRA 2010 revision series. In this session, we move into Chapter 4, which focuses on one of the most compliance-intensive areas of the Act: accounts, intimation, audit, and disposal of assets. Unlike registration provisions, this chapter deals with what happens after foreign contributions are received. We will study mandatory banking channels, reporting obligations, annual returns, record maintenance, audit powers of the central government, and the treatment of assets when an entity becomes defunct. These provisions are highly practical and frequently tested because they combine timelines, forms, reporting duties, and compliance requirements into a single framework. Chapter 4 establishes a rigorous monitoring framework for foreign contributions. The law ensures that foreign funds enter only through prescribed banking channels, remain separate from domestic funds, and are subject to continuous reporting and audit oversight. Every stage, from receipt of contribution to utilization and disclosure, is monitored through statutory requirements. The chapter also empowers the central government to conduct audits where non-compliance is suspected. Think of Chapter 4 as the surveillance and accountability mechanism of the FCRA, ensuring that every rupee of foreign contribution remains traceable and properly utilized. The 2020 amendment introduced a highly controlled banking structure for foreign contributions. Every person holding registration or prior permission must receive foreign contribution only through a designated FCRA account. This primary account must be opened in the specified branch of the State Bank of India at New Delhi, as notified by the central government. The objective is to create a single monitored entry point for all foreign funds entering the country. By centralizing the receipt process, the government gains greater visibility and control over foreign contribution transactions. Although all foreign contributions must initially reach the SBI New Delhi account, the law also provides operational flexibility. Once funds are received in the designated account, they may be transferred to another FCRA account maintained in any scheduled bank for keeping or utilization purposes. Further, One or more utilization accounts may also be opened in scheduled banks to facilitate spending. Thus, the law creates a three-layer structure. First, receipt through SBI New Delhi, transfer to a secondary FCRA account if required, and finally, utilization through designated spending accounts. This ensures both control and convenience. One of the strictest rules under the FCRA is the prohibition on mixing foreign and domestic funds. No money other than foreign contribution can be deposited into FCRA accounts. Similarly, foreign contribution cannot be received into or utilized from an account used for domestic receipts. The law requires complete segregation of funds to maintain transparency and traceability. For examination purposes, remember this simple principle. Foreign contribution and local funds must always travel through separate financial channels. Mixing them is treated as a significant compliance violation. The compliance responsibility does not rest only on recipients. Banks also have reporting obligations under Rule 16. The SBI New Delhi branch, scheduled banks holding FCRA accounts, and authorized foreign exchange persons must report prescribed details of foreign remittances. These details include the source of contribution, manner of receipt, and other prescribed particulars. The most important examination point is the reporting timeline. Banks must report receipt or utilization transactions to the central government within 48 hours. This rule applies regardless of whether the recipient holds registration or prior permission. Every person holding registration or prior approval has a statutory duty to inform the central government about foreign contributions received. The intimation must disclose the amount received, source of receipt, manner of receipt, purpose of utilization, and manner in which the funds were utilized. To ensure authenticity, the intimation must also be accompanied by a statement of foreign contribution particulars certified by a bank officer or an authorized foreign exchange person. These disclosures create a transparent trail that allows authorities to monitor how foreign contributions are being received and used. Apart from regular intimations, every eligible person must file an annual return in Form FC4. This return must be submitted electronically and should be signed or digitally signed. The filing deadline is within 9 months from the close of the financial year. Since the financial year ends on the 31st of March, the annual return must generally be filed by the 31st of December. Form FC4 serves as the primary annual compliance document under the FCRA and provides a complete summary of foreign contribution receipts and utilization during the year. Filing Form FC4 involves more than merely submitting the return. Several supporting documents must accompany it. These include scanned copies of the income and expenditure statement, receipt and payment account, and balance sheet. A certified bank statement relating to the exclusive foreign contribution account must also be attached. Additionally, the entire return must be certified by a chartered accountant. These requirements strengthen financial accountability and provide assurance regarding the correctness of disclosures made in the annual return. Foreign contribution does not always arrive in cash. It may also be received in the form of articles or foreign securities. When foreign contribution consists solely of articles such as goods or property, the recipient must furnish intimation in Form FC1. The same requirement applies when foreign contribution takes the form of foreign securities, such as shares, bonds, or similar instruments. Thus, irrespective of whether the contribution is monetary or non-monetary, reporting obligations continue to apply under the FCRA framework. A common misconception is that if no foreign contribution is received during the year, no filing is required. The FCRA takes a different approach. Even when absolutely no foreign contribution is received and no foreign contribution is utilized during the financial year, a NIL return must still be filed in Form FC4. However, the law provides some relief. In such cases, supporting documents like the Chartered Accountant Certificate, Income and Expenditure Statement, Receipt and Payment Account, and Balance Sheet are not required to be attached. Remember this exam point carefully. No activity does not mean no compliance. Filing remains mandatory. Compliance does not end after filing returns. The FCRA also imposes record retention requirements. All accounting statements relating to foreign contribution, including the Income and Expenditure Statement, Receipt and Payment Account, and Balance Sheet, must be preserved for a period of 6 years. The purpose is to facilitate future inspections, audits, investigations, and regulatory verification. Think of these records as the organization's compliance history. Even years after a transaction occurs, authorities should be able to trace and verify how foreign contributions were received and utilized. Section 19 requires every approved person to maintain proper records relating to foreign contribution. This includes maintaining an account of contributions received and records showing how those funds were utilized. Rule 11 of the FCRA 2011 further strengthens this requirement by mandating a separate set of accounts and records exclusively for foreign contribution transactions. In simple terms, foreign contribution accounting must remain completely isolated from domestic accounting. This segregation ensures transparency and makes regulatory monitoring significantly easier. The central government has the power to order an audit under certain circumstances. An audit may be directed if a person fails to furnish a required intimation under the Act. It may also be ordered where an intimation has been submitted, but is not in accordance with legal requirements. Additionally, if the government examines the available information and has reasonable cause to believe that provisions of the Act have been violated, an audit may be initiated. These triggers ensure that non-compliance or suspected irregularities can be investigated through an independent examination of records. When an audit is ordered, the central government may authorize a gazetted officer holding a Group A post or any other officer, authority, or organization it considers suitable. The authorized auditor is empowered to examine the books of account and verify compliance with FCRA provisions. To perform this function effectively, the auditor is granted a right of entry into the premises of the organization. This power enables the auditor to inspect records directly and ensure that foreign contribution transactions are properly documented and reported. Although auditors are given significant powers, these powers are subject to safeguards. Entry into premises must take place at a reasonable time and strictly after sunrise and before sunset. This restriction is frequently tested in examinations. Another important safeguard relates to confidentiality. Any information obtained during the audit must be treated as confidential and can be disclosed only for purposes connected with the enforcement of the FCRA. Thus, while the law enables effective regulatory oversight, it simultaneously protects sensitive information from unnecessary disclosure. Section 21 deals with a unique situation involving election candidates. Under the FCRA, candidates for election cannot accept foreign contribution. However, this provision applies to contributions received before they become candidates. If a person has received foreign contribution within 180 days immediately preceding the date on which they are duly nominated as a candidate, they must furnish specific details to the government. These details include the amount received, source of receipt, manner of receipt, purpose of receipt, and manner of utilization. The objective is to ensure transparency in electoral processes. The reporting obligation for candidates is governed by Regulation 18 of the FCRA 2011. The required information must be furnished electronically using Form FC1. The candidate must disclose the amount of foreign contribution received, its source, and how it was utilized. The most important point is the deadline. This intimation must be filed within 45 days from the date on which the person is duly nominated as a candidate. For exams, remember the combination of Section 21, Form FC1, and the 45-day reporting period. Section 22 addresses situations where an entity permitted to receive foreign contribution ceases to exist or becomes defunct. In such cases, assets created out of foreign contribution must be disposed of appropriately. If the entity is governed by a specific law, such as the Companies Act or Societies Registration Act, disposal will take place according to that law. However, where no applicable law exists, the central government will prescribe an authority and procedure for disposal. The process must take into account the nature of the assets and ensure that they are managed responsibly and lawfully. Let us conclude with the most important revision points from Chapter 4. Every foreign contribution must first enter through the designated SBI New Delhi FCRA account. Foreign and domestic funds must never be mixed. Banks have a strict 48-hour reporting obligation. Annual returns must be filed in Form FC4 within 9 months of the close of the financial year. Records must be preserved for 6 years. Election candidates must file Form FC1 within 45 days of nomination, and audits may involve authorized entry only after sunrise and before sunset. If you remember these timelines, forms, and compliance principles, you will have mastered the most examinable aspects of Chapter 4 under the FCRA 2010. Welcome to Parts 6 and 7 of our FCRA 2010 revision series. In this session, we move into the enforcement side of the law. Until now, we have focused on registration, reporting, banking procedures, and compliance requirements. Here, we will study what happens when those provisions are violated. We will cover adjudication, confiscation, appeals, revision powers of the central government, offenses, penalties, prosecution requirements, compounding of offenses, and miscellaneous enforcement provisions. These chapters are highly important for CA final examinations because they contain several timelines, monetary limits, appellate routes, imprisonment terms, and procedural safeguards that are frequently tested in both MCQs and case study questions. This session is divided into 4 important chapters. Chapter 6 deals with adjudication and confiscation of seized articles, currency, and securities. Chapter 7 focuses on offenses and penalties, prescribing punishments for various violations of the Act. Chapter 8 explains appeals and revision mechanisms available to aggrieved persons. Finally, Chapter 9 covers miscellaneous powers, such as inspection, investigation, exemptions, and the extent of applicability of the Act. Together, these chapters form the enforcement framework of the FCRA and are essential for understanding how compliance failures are addressed under the law. Section 28 establishes the principle of confiscation under the FCRA. Any article, currency, or security seized under the Act becomes liable for confiscation if it is adjudged to have been received or obtained in contravention of the law. In other words, confiscation is not automatic merely because an item has been seized. A formal adjudication process must first determine whether the item is connected with a violation of the Act. Only after such determination can the seized property be confiscated. This provision ensures that enforcement actions are supported by proper legal findings rather than mere suspicion. The authority competent to adjudicate confiscation depends upon the value of the seized property. A court of session has unlimited jurisdiction and may adjudicate confiscation irrespective of the amount involved. However, where the central government has notified an officer not below the rank of assistant sessions judge, that officer may adjudicate confiscation only if the value of the seized article or amount of currency does not exceed 10 lakh rupees. This 10 lakh threshold is an important examination point and should always be remembered while discussing adjudication powers under Rule 19 of the FCRA 2011. Once adjudication proceedings conclude, the authority may pass one of 2 orders. It may confiscate the seized article, currency, or security if it was used in connection with an FCRA offense. Alternatively, it may direct delivery of the property to the person legally entitled to possess it. Before passing any confiscation order, however, Section 30 requires compliance with the principles of natural justice. The person from whom the property was seized must be given a reasonable opportunity to make a representation. Thus, confiscation cannot occur without first granting the affected party an opportunity to be heard. The appellate route depends upon the authority that passed the original confiscation order. If the order was passed by a court of session, the appeal lies to the High Court, to which that session court is subordinate. If the order was passed by the notified officer or assistant sessions judge, the appeal lies to the court of session having jurisdiction over the matter. The appeal must be filed within 1 month from the communication of the order. However, the appellate authority has discretion to condone delay and permit filing for an additional period of 1 month where justified. Certain administrative orders may also be challenged through an appeal. Organizations declared to be of a political nature, persons restricted regarding foreign hospitality, entities denied registration or prior permission, and organizations whose registration has been canceled may appeal against such decisions. These appeals are filed directly before the appropriate High Court. The relevant High Court is determined based on the residence, place of business, place of work, or principal office of the appellant. The appeal must be filed within 60 days from the date of the order. Apart from appeals, the FCRA also grants revisionary powers to the central government under Section 32. The government may examine records of any proceeding to ensure legality and propriety. This power may be exercised either on its own motion, known as suo motu revision, or upon an application made by a registered person. After reviewing the records and conducting any necessary inquiry, the government may pass such orders as it considers appropriate. The revision mechanism acts as an additional layer of oversight and correction within the FCRA framework. Revision applications are subject to strict procedural requirements. Both suo motu revision and application-based revision are generally restricted to a period of 1 year. Applications must be filed electronically through the official FCRA portal and addressed to the Secretary, Ministry of Home Affairs. A non-refundable fee of 3,000 rupees is payable through the prescribed payment gateway. An important examination point is that if the central government declines to interfere in revision, the applicant has no statutory right to appeal against that refusal. The FCRA prescribes strict penalties for major violations. Under Section 33, knowingly furnishing false information or obtaining registration through fraud attracts imprisonment up to 6 months, fine, or both. Section 34 deals with violation of prohibitory orders and provides imprisonment up to 3 years, fine, or both, along with possible additional penalties. Section 35 addresses illegal acceptance of foreign contribution and carries the most severe punishment among these provisions, namely, imprisonment up to 5 years, fine, or both. These penalty amounts and imprisonment periods are frequently tested in examinations. Apart from the major offenses, the FCRA prescribes additional penalties for specific situations. Under Section 36, if an article, currency, or security liable to confiscation is unavailable for confiscation due to a person's act or omission, the court may impose a fine up to 5 times its value or 1,000 rupees, whichever is higher. Section 37 provides a residuary penalty for violations where no specific punishment has been prescribed, allowing imprisonment up to 1 year, fine, or both. Most importantly, Section 38 targets repeat offenders. A person convicted again under Sections 35 or 37 cannot accept foreign contribution for 5 years from the date of the subsequent conviction. This 5-year ban is a highly examinable provision. When an offense is committed by a company, liability does not rest solely on the organization. Section 39 provides that every person who was in charge of and responsible for the conduct of the company's business at the time of the offense is deemed guilty, along with the company itself. However, such persons can escape liability by proving that the offense occurred without their knowledge, or that they exercised all due diligence to prevent it. Directors, managers, secretaries, or other officers may also become personally liable if the offense occurred with their consent, connivance, or negligence. Remember that the term company is broadly defined and includes firms, societies, trade unions, and associations. Section 40 creates an important safeguard before prosecution. No court can take cognizance of an offense under the FCRA unless prior sanction has been obtained from the central government or an authorized officer. Section 41 deals with compounding of offenses. Certain offenses may be compounded before prosecution begins, provided they are not punishable with imprisonment only. A crucial examination point is the 3-year rule. If a similar offense was already compounded within the preceding 3 years, fresh compounding is not permitted. Once an offense is successfully compounded, no prosecution can be initiated for that specific offense. This mechanism promotes compliance while reducing unnecessary litigation. Chapter 9 grants significant powers to the central government and authorized officers. During inspections, authorized officers may call for information, require production of documents, and examine persons acquainted with relevant facts. Investigating authorities possess powers similar to those of a police officer investigating a cognizable offense. The central government may also exempt any person, association, or organization from the operation of the act, if such exemption is considered necessary in the public interest. However, this power cannot be exercised in favor of political parties or election candidates. Another important provision states that transactions between the Government of India and a foreign government fall completely outside the scope of the FCRA. Let us conclude with the key exam points from Chapters 6 to IX. An assistant sessions judge can adjudicate confiscation only up to 10 lakh rupees, while a court of session has no monetary limit. Appeals against confiscation orders must generally be filed within 1 month, whereas appeals against administrative orders have a 60-day limit. Revision applications must be made within 1 year and require a fee of 3,000 rupees. Penalties range from 6 months imprisonment for false intimation to 5 years for illegal acceptance of foreign contribution. Repeat offenders face a 5-year ban, and the 3-year rule applies to compounding of similar offenses.